Saudi Arabia. 80 years of dollar exclusivity. One diplomatic summit. The entire petrodollar framework now standing on a cliff edge. The kingdom that built American monetary dominance is quietly dismantling it, and Washington is pretending not to notice. Immediate consequence, 015-030. Here's what this means for your wallet. Every time you fill your gas tank, every time grocery prices tick higher, every time your retirement account shifts, part of what determines those numbers is which currency oil trades in. Saudi Arabia just opened the door to alternatives, and that door doesn't close. Credibility plus subscription pitch 030-050. This channel runs on no corporate funding, no government backing, and no advertising pressure telling us what to leave out. The analysis that needs to happen about what Saudi Arabia signaled at the BRICS summit is not happening on mainstream platforms. It's happening here. If this kind of depth matters to you, the kind that connects the diplomatic handshake to your economic reality, hit subscribe and turn on notifications. Deep dive layer. A. What happened? 050-230. Let me show you exactly what happened. August 2023. Johannesburg, the 15th BRICS Summit. Saudi Arabia receives formal invitation to join the bloc alongside 5 other nations. The Saudi delegation doesn't reject it. They don't accept it immediately. They do something more calculated. They acknowledge interest pending internal review. That diplomatic language matters. For 8 decades, Saudi Arabia's foreign policy has orbited one central commitment: oil trades in US dollars. Every barrel, every transaction, every contract. The petrodollar system, born from Franklin Roosevelt's 1945 meeting with King Abdulaziz on the USS Quincy, created the foundation for American monetary hegemony. Saudi oil priced exclusively in dollars meant global demand for dollars, regardless of American economic fundamentals. The kingdom upheld that framework through multiple American administrations, through the 1973 oil embargo, through the Iraq wars, through the fracking revolution that made America a competitor, through Yemen, through Khashoggi. Through every policy disagreement, the dollar arrangement held. Now Saudi Finance Minister Mohammed al-Jadaan states publicly that the kingdom is open to trading in currencies other than the US dollar. Direct quote, "There are no issues with discussing how we settle our trade arrangements, whether it is in the US dollar, whether it is the euro, whether it is the Saudi rial." That statement represents a seismic shift in policy architecture. Here's the timeline that matters. January 2023, China and Saudi Arabia discuss yuan-priced oil contracts. March 2023, Saudi Arabia joins the Shanghai Cooperation Organization as a dialogue partner. June 2023, Saudi Crown Prince Mohammed bin Salman meets with Chinese President Xi Jinping in Beijing. August 2023, BRICS invitation received and acknowledged. December 2023, Saudi Arabia confirms ongoing evaluation of BRICS membership. The official narrative from Western think tanks describes this as diplomatic balancing, Riyadh maintaining relationships with both Washington and Beijing, standard hedging behavior from a regional power navigating great power competition. Der Fortschritt Yataswarchim, is Makramikorchim, is Mater Stiers, Niter Stiers, is Dater Stier. Deep dive layer B, why official story is incomplete, 230-345. The official narrative says Saudi Arabia is just exploring options. The operational reality shows a kingdom systematically building alternative infrastructure. Look at what the comfortable explanations ignore. Saudi Arabia didn't just receive a BRICS invitation. The kingdom negotiated terms. Mohammed bin Salman's government spent months in direct consultation with Chinese and Russian officials about the structure of potential membership. That's not casual diplomatic engagement. That's architecture building. The timing reveals intent. These discussions accelerated immediately after the Biden administration's response to oil production cuts. When OPEC Plus reduced output against American pressure in October 2022, Washington's reaction included threats of consequences and legislation targeting the cartel. Saudi leadership watched the country that supposedly guaranteed their security publicly discuss punitive measures against their core economic decisions. Then there's the infrastructure no one wants to calculate. Saudi Arabia now holds strategic dialogue status with the Shanghai Cooperation Organization. The kingdom signed a comprehensive strategic partnership with China worth over $30 billion in direct investment. Saudi Aramco announced plans for a massive refinery complex in China's Liaoning province. These aren't hedges. These are alternative foundations. Western analysis keeps describing this as Riyadh playing Washington and Beijing against each other for maximum leverage. That frame assumes the goal is better terms within the existing dollar system. What if the goal is exit infrastructure from that system entirely? Is majors just the mayor Deep Dive Layer C, Technical Explanation 3:45:5-30. To understand why this matters, you need to understand what the petrodollar actually is. It's not a formal treaty. There's no signed document called the Petrodollar Agreement. It's a system built on Saudi commitment and American security guarantees. The mechanism works like this. Saudi Arabia prices oil in dollars. Global buyers need dollars to purchase Saudi oil. Those buyers must either earn dollars through exports to America, borrow dollars from dollar-denominated financial institutions, or hold dollar reserves. This creates structural demand for U.S. currency regardless of American economic performance. That structural demand allows the United States to run persistent trade deficits without currency collapse. America imports more than it exports year after year. Any other nation doing that would see currency devaluation, but dollar demand from oil purchases creates a floor. Other countries need dollars, so they buy U.S. Treasury bonds, financing American deficit spending. The numbers show the scale. Daily global oil consumption, approximately 100 million barrels. Average price over the past decade, roughly $70 per barrel. That's $7 billion in daily oil transactions. Multiply across a year, too. $5 trillion in oil trade. Not all of that is Saudi production, but Saudi Arabia remains the largest exporter with swing production capacity that influences global pricing. When oil trades exclusively in dollars, that too, $5 trillion in annual transactions requires dollar liquidity. Financial institutions worldwide maintain dollar reserves to facilitate energy purchases. Those reserves get parked in U.S. Treasury securities. The U.S. government can borrow at lower interest rates because global demand for treasuries is partially captive, driven by oil market requirements, not just confidence in American creditworthiness. Now consider the alternative. BRICS nations represent 42% of global population. Their combined GDP, measured by purchasing power parity, exceeds the G7. If Saudi Arabia joins and begins pricing even a portion of oil exports in yuan, rubles, or a future BRICS currency, the structural demand for dollars diminishes. China imports approximately 11 million barrels of oil per day. That's $770 million daily at current prices, or $280 billion annually. If China purchases Saudi oil in yuan instead of dollars, that's $280 billion in annual transactions, no longer requiring dollar intermediation. Beijing can pay in its own currency. Riyadh can hold yuan reserves or use them for Chinese imports. The ripple effects compound. If Saudi Arabia accepts yuan, other producers face pressure to offer the same terms or lose market share. Russia already sells oil to China in yuan and rubles. Iran would gladly accept yuan. Venezuela, under sanctions, has motivation to bypass the dollar. The United Arab Emirates has already conducted yuan-settled LNG transactions. Deep Dive Layer D, What They're Not Telling You, 53065. Here's what the financial press is leaving out. This isn't just about oil pricing. It's about the infrastructure being built to make de-dollarization operational, the Cross-Border Interbank Payment System, CIPS, China's alternative to SWIFT. The system processed over 80 trillion yuan in 2022. That's roughly 12 trillion US dollars equivalent. Participation has expanded to more than 1,300 financial institutions across 100 countries. Saudi banks are exploring integration. The digital yuan, China's central bank digital currency, fully operational. Already used in cross-border settlements with multiple nations, the technology allows instant currency conversion without dollar intermediation. A Saudi exporter could receive digital yuan, convert immediately to rials, with no dollar touching the transaction. The gold factor. BRICS nations have been accumulating gold reserves at rates that dwarf Western central bank purchases. Russia added 2,500 tons since 2007. China's official reserves show 2,000 tons, but credible estimates suggest actual holdings exceed 4,000 tons when you include non-central bank state purchases. Saudi Arabia holds 323 tons. These reserves create potential backing for alternative settlement mechanisms, the commodities dimension. It's not just oil. Saudi Arabia is discussing yuan-priced contracts for petrochemicals, minerals, and manufactured goods. The kingdom wants Chinese investment in NEOM, the $500 billion megacity project. That investment can flow in yuan. The construction contracts can be yuan denominated. The entire economic relationship can operate outside dollar rails. There's an insurance policy being built here. If Washington ever decides to weaponize the dollar system against Saudi Arabia, freezing assets, blocking transactions, imposing sanctions, the kingdom is constructing parallel infrastructure that continues functioning. Deep dive layer E, connect to bigger pattern, 645, 815. Now let me show you why this isn't just a bad day for dollar dominance. This is a structural problem that doesn't go away. The pattern repeats across multiple theaters. France completed its first LNG transaction with China settled in yuan. Brazil and China established direct currency swap arrangements, eliminating dollar intermediation and bilateral trade worth over $150 billion annually. Argentina is considering yuan reserves to bolster central bank holdings. Kenya is discussing yuan payments for oil imports. Each individual arrangement is small. France's LNG deal was 65,000 tons. Argentina's potential yuan reserves might reach $6 billion. Kenya's oil imports are modest in global terms. But the pattern is what matters. Nation after nation is building the infrastructure to transact without dollars when necessary. The motivations vary. Some countries face sanctions and have no choice. Others see diversification as prudent risk management. Some are explicitly aligning with China's geopolitical sphere, but the effect is the same. The network of dollar-dependent transactions is developing alternative pathways. Saudi Arabia's position makes this pattern systemic. The kingdom isn't Iran, forced out of dollar markets by sanctions. It isn't Argentina, desperate for any source of hard currency. It isn't Kenya, lacking global financial influence. Saudi Arabia is the linchpin, the country whose oil policy created the petrodollar, the nation whose reserves and production capacity can move global markets. If Saudi Arabia normalizes multi-currency oil pricing, every producer has cover to do the same. OPEC meetings could start discussing yuan pricing. Long-term contracts could include currency optionality clauses. The standard assumption that oil equals dollars begins to crack. The second-order effects cascade through the financial system. Lower structural demand for dollars means lower demand for treasuries. Lower demand for treasuries means higher interest rates required to attract buyers. Higher interest rates mean increased cost of servicing America's $33 trillion national debt. The U.S. government paid $659 billion in interest in fiscal year 2023. Every percentage point increase in average rates adds hundreds of billions to annual interest costs. The Federal Reserve's options narrow. If Treasury yields spike, the Fed faces pressure to intervene by purchasing bonds, expanding the money supply and risking inflation. If the Fed doesn't intervene, the government faces fiscal crisis from debt service costs, consuming ever larger portions of the budget. Nature or geo nin. This nature tio. You tio nature ne. You math section 8:15:10. Let me show you the numbers that explain this entire shift better than any diplomatic analysis. U.S. national debt, $33 trillion. Annual interest payments, $659 billion in fiscal 2023. That's already 15% of all federal tax revenue, just servicing existing debt. The Congressional Budget Office projects interest costs reaching $1.4 trillion annually by 2033 under current policy. Those projections assume continued ability to borrow at relatively favorable rates. That ability depends partially on structural dollar demand from the petrodollar system. Now run the scenario where that demand decreases. Current 10-year Treasury yield approximately 4.5%. If structural demand drops and yields rise just 2 percentage points to 6.5%, the interest cost on new borrowing and refinanced debt increases dramatically. The U.S. government refinances roughly 25% of outstanding debt each year. That's $25 trillion in annual rollover. A 2% rate increase on that rollover equals $165 billion in additional annual interest costs immediately. As more debt matures and refinances at higher rates, that compounds. Compare that to China's position. China holds over $3 trillion in foreign exchange reserves. If UN-priced oil becomes normalized, China needs fewer dollars. Those reserves can shrink. The pressure to continuously buy treasuries to maintain dollar liquidity diminishes. China's treasury holdings have already declined from a peak of $1.3 trillion to approximately $850 billion. That's a 35% reduction. If the trend continues and accelerates, who replaces that demand? The Saudi numbers make it concrete. Saudi Arabia exports approximately 7 million barrels of oil per day. At $80 per barrel, that's $560 million daily, or $204 billion annually. If even 25% of that shifts to yuan pricing, that's $51 billion in annual transactions, no longer requiring dollar facilitation. That might sound small against the entire global dollar system, but it's the precedent that matters. If Saudi Arabia does it, the UAE will consider it. If the UAE does it, Kuwait might follow. Iraq is already selling oil to China in yuan. The velocity is what makes this asymmetric. The U.S. government needs to place approximately $2 trillion in new debt annually to cover deficits and refinancing. Any reduction in structural demand from the petrodollar system tightens the buyer base. The math doesn't reverse. Once alternative infrastructure is built, it remains available. The path back to exclusive dollar pricing requires Saudi Arabia to voluntarily surrender optionality it has created. Why would they? There's no winning this equation. The United States cannot force Saudi Arabia to price oil in dollars without enforcement mechanisms that would destroy the relationship entirely. Sanctions against Saudi Arabia would crater global oil markets and spike American gas prices. Military pressure is unthinkable against a nation hosting American bases and buying American weapons. The leverage is gone. The kingdom produces oil at approximately $10 per barrel cost. They can sell profitably at prices that would devastate American shale producers operating at $40 to $50 break-even points. Saudi Arabia holds $750 billion in foreign reserves and runs budget surpluses with oil above $70 per barrel. They have financial cushion to weather any American economic pressure. The United States produces approximately 13 million barrels per day domestically but consumes 20 million. That 7 million barrel per day deficit requires imports. Alienating Saudi Arabia doesn't hurt Riyadh's ability to sell oil. It hurts American ability to access affordable supply. $100 billion in annual Saudi oil revenue shifted to yuan. $165 billion in additional U.S. interest costs from just 2% yield increase. $450 billion in potential treasury demand reduction if China and Saudi Arabia both decrease dollar reserve accumulation. Read those numbers again slowly. The fiscal math is brutal. There's geopolitical chessboard, 10 on 1230. China's leadership is watching this develop with strategic patience. Beijing has spent 2 decades building the infrastructure for exactly this moment. The Belt and Road Initiative, the Asian Infrastructure Investment Bank, the BRICS New Development Bank, CIPS payment systems, digital yuan technology. All of it designed to create alternatives to Western-dominated financial architecture. Saudi Arabia joining BRICS is not the goal. Saudi Arabia willing to join BRICS is the goal. The optionality itself changes the negotiating dynamics with Washington. Every conversation between Riyadh and Washington now carries implicit leverage. The kingdom can diversify. The infrastructure exists. The relationships are built. That possibility reshapes American policy constraints. China doesn't need Saudi Arabia to abandon the dollar entirely. Beijing needs the dollar's position as the sole option to end. Once oil trades in multiple currencies, once the precedent is normalized, the advantage compounds. Every nation currently holding excess dollars because they need them for energy purchases can recalibrate. Those reserves can shrink. That demand for treasuries can decline. Russia is already operating outside the dollar system for most transactions. Sanctions force the development of alternative mechanisms. Russia now sells energy to China, India, and Turkey in rubles, yuan, and rupees. Trade with Iran uses barter and local currencies. The Russian financial system has demonstrated that major economies can function without dollar access if they're willing to build alternatives. What Iran, Russia, and Venezuela did under duress from sanctions, Saudi Arabia is now considering voluntarily from position of strength. That's the evolution that changes the game. Sanctioned nations had no choice. Major U.S. partners choosing alternatives signals system-level shift, not isolated punishment. The Global South is drawing conclusions. Every nation that has watched America freeze Russian central bank reserves, cut Iran out of SWIFT, sanction Venezuela's oil sector, and threaten secondary sanctions against countries trading with these nations understands the message. Dollar dependence is a vulnerability. The U.S. government weaponizes the financial system when geopolitical interests align. Building optionality is not just economically prudent, it's existential risk management. Nigeria is watching. Indonesia is watching. Malaysia is watching. These are large economies with significant oil production or consumption. If the petrodollar framework cracks, each of them faces a choice. Maintain dollar dependence and accept the constraints, or diversify and gain negotiating leverage. The rational choice is obvious. The European position is complicated. The euro exists as an alternative reserve currency, but European economies are deeply integrated with the dollar system. European banks facilitate dollar transactions globally. European companies operate in dollar markets. European central banks hold substantial treasury reserves. But even Europe is quietly exploring alternatives. The European Central Bank has discussed digital euro implementation. France completed that yuan-denominated LNG transaction. The continent isn't abandoning the dollar, but it's building optionality. India's calculation is particularly interesting. New Delhi has traditionally maintained non-aligned foreign policy. India buys Russian oil at discounted prices settled in rupees and dirhams. India conducts trade with Iran using rupees. But India also maintains strong ties with the United States and shares Washington's concerns about Chinese influence. If Saudi Arabia normalizes multi-currency oil pricing, India gains flexibility without forcing a binary geopolitical choice. This is where the Saudi decision becomes systemic. Every major economy watching this understands that once Saudi Arabia demonstrates multi-currency oil trade functions smoothly, the barriers disappear. It's not theoretical anymore. It's operational. The proof of concept is established by the most important producer in the market. Closing. Stakes summary. 12/30/13. What's being built in Riyadh and Beijing right now is not just a payment system alternative. It's the dismantling of the architecture that has allowed the United States to borrow without consequences for 50 years. The moment the petrodollar system becomes optional rather than mandatory, the fiscal math of American power changes permanently. Transformation to the starturnse sectorsa is bishasak is durturnse is mayan is their prediction framework. 13/13/45. Here are my 3 predictions with a clock attached. First, within 18 months, Saudi Arabia announces formal acceptance of BRICS membership or completes its first major oil transaction with China settled in yuan. The infrastructure is already built. The political decision is what remains. Second, by 2026, at least 3 additional major oil producers announce multi-currency pricing frameworks, citing Saudi Arabia's precedent as justification. The normalization cascade begins once the kingdom moves. Third, U.S. Treasury yields increase by at least 100 basis points within 24 months of Saudi multi-currency normalization as structural dollar demand decreases and buyers require higher returns to absorb American debt issuance. Yes. Comment hook 13/45/14. Drop your prediction in the comments. Which happens first? Saudi Arabia formally joins BRICS, the first major yuan-priced Saudi oil contract, or Treasury yields breaking 6%. Tell me because I read every single one. Is motor say share CTA 14/14/15. If this gave you a framework for understanding why the Saudi BRICS story is not just diplomatic theater, but the foundation of your economic future, share it with one person who needs to understand what's actually happening. Enter teaser 14/15/14/30. The next video goes somewhere even this one didn't reach. What happens to the dollar when the oil connection breaks and the treasury market has to compete for buyers without captive demand? Subscribe so you're there when it lands.